Hi, good afternoon. This is Michelle from Central Canada, and I'm the 2024 Central Canada Chapter President. Thank you again for joining us today at our webinar, 2024 Commercial Real Estate Insight for Region 12 with our friend Raymond Wong, CLE from Altus Group. We'd like to take a moment to thank and recognize the sponsor that we have in our chapter. It is with their year-round support that we are able to bring you the programming like this, as well as all the exceptional events that we are coming to rely on. Let's take a look at our sponsor today. We have the Central Canada's 2024 chapter sponsor, Gaggan and Halley from Sherwood Mortgage Group. And then we have Royal LePage as our 2024 venue sponsor, and also the EXP Enrich Group for our 2024 venue sponsor. And speaking of venue sponsor, there will be an introduction to CLE course happening in August 15 at their premises in Richmond Hill. Please register now to get introduced to CLE. So the session will promptly begin at 1 p.m., so let's get ready.
Hi, everybody. Welcome. Thanks so much for joining us. Would like to take a moment here to thank our working partnerships and sponsors here in Western Canada, including the Greater Vancouver Realtors Association, the Greater Vancouver Board of Trade, the American Chamber of Commerce, Invest Vancouver, and the Canadian Real Estate Association. And we're very grateful for all their support as we move toward hosting the 2025 governance meetings here in Vancouver, which we hope to see many of you there, and I look forward to pinning as many as possible. I'll kick it back to Michelle, and thanks very much for joining us today.
Thank you. So welcome to today's webinar, 2024 Commercial Real Estate Insight for Region 12. And we are happy to share this webinar with everyone in the industry today for the members of CCIM Institute, and it's just one of the many members' benefit that we designed to help you adapt and thrive in 2024 and beyond. Steve, do you want to introduce Raymond for us?
Happy to. Thanks again, Michelle. For everyone, I'm Steve DeCruz. I'm president of CCIM Western Canada and executive vice president, co-founder of CASM Global, based here in Vancouver. Welcome to today's webinar. We're happy to share this webinar with everyone in the industry today. For members of the Institute, this is just one of the many member benefits we're very proud and excited to share with you here in 2024 and beyond. Joining us today is the esteemed Raymond Wong, CRE from the Altus Group. If you haven't listened to him before, this is your lucky day. And if you have before, you'll know there's a lot of wisdom coming your way. Raymond is going to analyze key factors such as inflation, policy changes, and housing data to highlight major trends affecting the primary commercial real estate sectors, mainly office, multifamily, retail, and industrial, the big four food groups. Please feel free to keep in mind any questions you like. We're going to have a healthy Q&A here at the end of the presentation. So you can either enter those in the chat or have them ready afterwards, and we'll get into those. Raymond, thanks very much. It's great to see you again and spending time with us. So I'll turn it over to you to take it away.
Thanks, Steve. I just hope I can just live up to your intro with respect to the presentation. Can you see it? So we're good?
Yes,
looks good.
Okay, great. Thanks. Just trying to make some adjustments to it. Okay, so the challenge right now is what we're going through is there's a lot of data out there, and there's a lot of different trends that are happening. And just to start off with respect to the interest rates, the 50 basis point drop in the Bank of Canada rate this year has helped to a certain extent, And especially with the 5-year mortgage rates, it's heading in the right direction. The challenge with it is, depending on what happens with the U.S. over the next 6 or 7 months, based on the election, based on the Fed's decision in September, it will sort of mark how quickly our interest rates will come down. We had a number of false starts, especially with this year, anticipation more of a drop in interest rates in the spring that didn't happen. As a result, we've seen sort of commercial real estate transactions pull off, as well as the impact on the housing sector with respect to interest rates remaining at a high level. So one thing that we can be sure of is that it'll be better in 2025, and hopefully we won't have another sort of false start to be in the year as we've had over the last couple of years. So I think that overall is a positive. The housing affordability impact of movement of talent. This is sort of my go-to favorite slide. And it shows you, based on sort of the affordability, that we've had sort of, and again, this is the interprovincial migration, and it doesn't include the immigration. When you throw in immigration, that's where Ontario is positive, especially with the GTA. But you look at Alberta, they've had consistent growth over the last couple of years, and especially with their aggressive tactics with targeting BC and Ontario to push for sort of affordable housing. This is going to bode well for Alberta going forward, just because of the amount of talent and people that have shifted to Alberta based on lowering prices, and especially with arguably higher office vacancy rates in Calgary that we'll get into during the presentation. It's all positive, especially with companies and especially with Alberta sort of trying to pivot or having less dependency on the resource sector. So I think this positions them well sort of going forward, and especially with any type of recovery. So when you look at the housing starts, and again, this is from our economics team at Altus, and the impact of the interest rates and relatively uncertainty, because even with the U.S. now, whether or not there's that recession or R word that keeps coming back, and whether or not that takes place, that housing is starting to come back a little bit, but again, until interest rates move to a certain level, and as well as more confidence in the economy and the GDP growth, I don't think that's going to happen until sort of late this year, early next year. And with respect to the consumer side, I think all of us have felt that, even though the numbers don't indicate it, that we have been in a recession, and that sort of reflects in the retail sales, especially with type of retail activity that is going on in the marketplace. When you look at new condominium apartment sales, and again, this has been on the news quite a bit, especially with the drop in sales from in the GTA. And last year was bad, and this year's even worse. And whereas we're seeing a little bit of pickup in Vancouver, but especially with Edmonton and Calgary, they continue to be strong in that sense. When you look at the months of inventory, this is where the real challenge has come in. GTA is at 16 months versus Vancouver at 10.6. Again, this is why we're definitely seeing a bit of a slowdown in condominium construction and launches. And again, I think we've also seen some aspects of some receiverships, and it'd be interesting to see the one condominium project listed at 1.2 billion, whether or not a buyer steps forward or what happens with that project going forward. So again, I think it'll be a different picture by the beginning of next year, especially with no new, or there's still starts on the condominium side, but less so compared to a typical market. New single semi-home activity is up, but again, as compared to a year ago, and I think there's more activity on the semis versus the singles. But you look at Vancouver, still a little bit more challenged, and Edmonton and Calgary still growing, especially on that demand. The price gap between Edmonton and Calgary has been shrinking. Calgary is still outpacing on pricing, but Edmonton is also seeing some of that benefit with affordable housing shifts and overall activity. And of course, townhouse activity continues to be on the rise. And again, that's not a surprise based on the price of single family housing. And again, this is more pushed from user side rather than on the condo side, is a little bit more geared to on the investor side. So we're seeing a bit of a pickup in this area on townhouse activity. So when we look at the impact of the interest rates on the housing side, we're still seeing a little less or softening activity in the new home side going forward. Again, based on the interest rates and depending on how high they remain at this level, we're going to be sort of sluggish in the way of starts and sales activity, I think, for the remainder of this year. And we probably will be closely tied with interest rates with respect to increased activity for next year. So turning to the commercial side, we produce an investment trend survey every quarter. So this is a survey of close to about 400 of our clients, investors, and owners, and brokers. And this is not a big surprise with overall location barometer when investors are looking at products. And Vancouver, Toronto always show up strong, but now we're seeing some positive momentum in Edmonton and Ottawa. Big surprise here, sort of, is Halifax, and I think that's also based on the amount of survey results we have for Halifax. But typically, it's usually Vancouver, Toronto, and Montreal. And Montreal is a little bit negative, but I think this is sort of a short-term blimp on the location parameters as a preference. With respect to property type, that where's the biggest interest? Of course, food anchor retail strip remains strong, industrial, multifamily, and the product that is least of preference is on the office side. But this is not so much when you look at the activity in office sales, that the challenge with the most preferred asset type for investors is that there's not a lot of product in that area, and when there is product, there's a bit of a premium. Whereas what we've seen over the past 18 months is a steady decrease on the office side, especially with the impact of return to the office. And again, the numbers are starting to pick up a little bit, but again, the preference continues to be the mainstay with food anchor retail as well as industrial and from the office front. And we are sending a copy of this presentation out after the after we go through this. But this gives you from our investors the top 15 preferred locations and asset types, as well as the least preferred. And again, it's sort of this breaks it down on the market basis. But it's interesting with Edmonton and Calgary that investors see sort of opportunities for for acquisitions in those marketplaces, and sort of the secondary and tertiary markets that are getting a little bit more attention based on some of the pricing. When you look at investment activity, again, the second half of 2024, first quarter, the numbers were down by about 20% on a national basis. In sort of a year-to-date, sort of mid-year 2024, the numbers are up. And a lot has to do with the capital gains tax that was brought in. We saw increase in activity significantly in Montreal, Toronto, and Vancouver. And those are the market deals, but we also seen sort of a quadruple of activity for non-arm's length transactions. So it's had a positive impact on the numbers because, again, we're going to be probably closer when we get the final numbers for 2Q 2024, at least about 26 or $26.5 billion, so almost equivalent to a year ago. But again, we're not sure if we're going to see that level of activity to continue, especially with not having that one event with the capital gains tax that was pushing the overall market activity. So it remains to be seen for the third and fourth quarter, especially with interest rates remaining at a certain level, and as well as the amount of uncertainty in the marketplace, especially geopolitically, what's happening in the Middle East, and as well as the potential impact to the economy and with possible tariffs with the U.S. Presidential election that is coming up that may impact the market. So it remains to be seen. We're cautious going into the second half of this year, a little bit more optimistic going into 2025. So in the way of cap rates, and this goes back with our investment trend survey. So you're seeing continued increase or flattening of the cap rates. And downtown office AA, you're actually seeing office rents increase in those, especially on the newer buildings. So I think that's why cap rates have moved down a little bit, but essentially it's just flat. The challenge we have with the cap rates as well is again the overall impact of the interest rates going forward. So we expect more of a flattening into this year, and perhaps cap rates will sort of pull some of the cap rates down. But for especially on industrial, we've seen a pullback in that area, and based on borrowing at between 6% and 7%. What we saw at the height of the investment market when industrial was between 3% and 4%. The rents are starting to flatten in that area, so it really doesn't really justify some of the premiums that are attached to some of the industrial product. That's why I think we're seeing a bit of a slowdown there in the way of sales and lease activity. And turning to the industrial market, you've seen the overall availability rates increase, but it's still at historical lows. But the challenge with this is, I guess, less so compared to the office side. But the sublet numbers, especially in Toronto, as a percentage of the overall available space, is starting to creep up. And we are seeing sort of a softening in rents overall, but the better, more modern industrial buildings are still seeing increases. I'm not sure they're seeing the 15 to 20%. The average increase in rents that we've seen so far this year have been more moderate, between anywhere from 3 to 6%, and definitely not the 10 to 25% that we've seen 2 years ago. And partly it's due to the completions, the amount of completions coming up and the space available. A lot of these buildings in the past, when the building was actually complete, they were sort of more or less 100% leased upon completion. And that's not the same story right now. We're in in 2Q, the space that was completed, 50, close to 60% of that space it was available. So that's pushing the availability rate up. When we look at under construction, it's the same story. So we're probably going to see a pullback in some of this construction activity based on the pre-leases in industrial buildings. But we like industrial just because even though the market's softening, that when you look at e-commerce and continued growth in the retail sales, that industrial remains a demand commodity. That it's just the new supply has sort of caught up with the undersupply that we saw in the last 4 years. And I think we're going to see some of that new construction activity starting to come off a little bit. When you look at the rents, again, you're seeing some of the rents starting to flatten a little bit. Toronto and Montreal has seen some really good new supply hitting the market, pushing the numbers up. But industrial for Toronto still have some of the older industrial product that is causing those rents to come down a little bit. But again, what we're sort of anticipating this year is more of a flattening of industrial rents compared to the recent past. Turning to, sorry, were there any questions, or are we good to continue the presentation?
I think we can keep going, Raymond, and then do a round of general conversation after.
Okay, great. So turning to the office market. So again, with the impact of the economy, I thought there's been a shift, especially with the unemployment rate starting to increase to a certain extent, especially with some of the impact on the tech sector, that some of that shift in sort of influence is going back to the employer. But again, I'm not sure if this is short term, but we are seeing the impact on return back to the office with downtown Toronto. And this is happening in other markets as well, especially with respect to your Ottawa, whereby you don't have that commuting issue that Toronto, Vancouver, and Montreal has. But again, this is a reflection of increase in mandates for certain companies who are now taking attendance to a certain extent of monitoring people who are coming back in 2 to 3 days a week. And again, I think it's a positive, but you still see in the downtowns of empty retail, and as well as the food court is not 100% leased, but we are seeing some comeback in that area. And you're definitely seeing the increase. Well, in Toronto, you see the increase in congestion, but I'm not sure if that's because people are coming back in or because the lack of open roads due to the construction that is happening. But overall, public ridership is up. But again, we are still below to pre-pandemic levels with respect to public transit usage. So this is positive that we are still seeing an increase. But again, we're not seeing the same thing with respect to the pre-pandemic, whereby Stats Can reported back then that only 80% of people actually came into the office, but that was 5 days a week. When you look at 67% or the peak at 77%, that's based on usually Tuesday to Thursday, and we all know it falls off on the Monday and the Friday. So you have to watch how the stats are reported. One of the big thing right now is the work-life balance shifted. We've been 2 or 3 years in sort of that work for home, and we're used to it. In between meetings, we can dump a load of laundry into the wash while we're in between meetings, and you can't really do that at work, and as well as pick up the kids or running errands during the day, having that flexibility. So I'm not really sure how we can sort of go back, and I don't think we will 5 days a week. but there's more of a push on work-life balance, and this hybrid model has allowed us to facilitate that. So not really sure how many people sort of want to go back into the office. And again, even with the shift to Alberta with the workers, and again, that was a push with respect to ability to be flexible and to work from anywhere. And if companies start to see this as a need for as a requirement, I'm not sure we can see the shift. In Ontario and Southwest Ontario, people have moved Southwest Ontario. Some of them actually come in on a Tuesday and they're staying in a hotel for 2 days and go back home on a Thursday, because the challenge for them as well as is to they can't really afford to move back into the city, and they also like the space where they're at right now. So that's still sort of a wait and see. With respect to the office availability rates, Calgary is coming down, whereas Vancouver and Toronto, they're starting to level off to a certain extent. But the big news is downtown office um, Class A vacancy rates. And again, this is where you hear most of the office activity occurring with respect to lease activity. And what we're watching here, the Class A vacancy rate. So this is basically space that is vacant and with landlords not getting rent on. So even though we've seen a flattening of overall availability rates, the vacancy rate's creeping up, which means that one, the sublet space is burning off, and two, there's a lot of blend and extends in the marketplace, whereas the owners are taking back more of that space. And especially with Toronto downtown, 9.3, almost 100 basis points up from the previous quarter, that's showing that that impact of some of the blends that expand and some of the sublets just expiring on the term. When you dig a little bit deeper, again, there's a lot of data to look at. So there's a downtown Class A, and again, those numbers are relatively high, but when you look at select Class A, and that's basically office buildings downtown, 500,000 square feet, Class A built after 2015, their sort of vacancy rates are significantly lower. So the preference for a lot of the tenants is not just Class A, but Class A new. And that's where we're seeing a lot of this, the very low vacancy rates and availability rates in the better buildings compared to overall Class A. And look at the sublet impact. It's at 23% for downtown and Class A. And even though the Class A select is around 2.3%, 75% of that is on the sublet side. And whether or not that actually continues to be that high, it will be interesting, but it still represents a very low availability rate in that area. But as a percentage of the overall space, sublet space remains majority of the space that is leasable. So for the landlord, that actually is a positive, because for all that sublet space, they're still getting paid on rent. So on the direct vacancy, it remains relatively low. So when we look at aspects of under construction, again, we're just coming down to the final buildings that we're already committed for Vancouver and Toronto. It remains very low in the way of availability, which is a positive. Office construction continues to be slow, and again, not a lot of new announcements and projects. Return to the office obstacles remains with congestion, especially with Vancouver, Toronto, and Montreal continues to be an issue. When you turn to the retail sector, this is one of the bright spots that we're seeing, especially with people. Again, we're still in a bit of a consumer recession, but the numbers are popping up, especially with luxury retail. You can see that with Yorkdale Shopping Center and the Eaton Center. So even with the the Pacific Center in Vancouver, it's going positive, and we're also seeing rent growth of sales increasing in all those sectors that are making retail centers a little bit more attractive. But the focus again is on sort of necessities. So I think we're going to see sort of retail sales flattening until we see a little bit more confidence in the marketplace. And the strongest growth that we've seen is Alberta and Quebec, and less so with BC and Ontario. But again, we are seeing rent growth in that area, in part probably due to the immigration and demographics that shift that we're seeing increase in retail spending. And again, what we're seeing here is that for the first time in a while, increased rents and especially some of the regional malls, and compared to the last couple of years, retail is starting to come back. So is the worst over? If we keep saying it enough, that hopefully we are. So there is discussions about we've hit sort of bottom in the way of investment activity. We are starting to see, again, anticipated lower rent interest rates that will sort of push the economy forward. But overall, market fundamentals remains largely positive. So from that aspect, it's sort of trying to get through this year. And again, what we said last year, wait until 2024, is hang on into 2025. So, there are some overall concerns, but overall we're in a good spot, especially if you believe that we've hit the bottom and we're starting to come out of this slowly. But it's just going to take a little bit more time and probably into next year. So that is the presentation. So Steve, I'll turn it back over to you.
I love a good trough call, Ray. So I appreciate the positivity at the end there. Thank you.
Well, I was trying, Steve. It was difficult for a while.
I thought it's supposed to be the dismal science on the economy side. So glad to have the positive note. I actually was also going to mention, I think this is the first presentation I've been in for a very long time that didn't have the words artificial intelligence and data center throughout. I'd love to get, I can see you rolling your eyes, so I'd love to know, what's your take here? Because we're not really seeing it as a finished asset. It's still in the early stages of being rolled up. How are you seeing things?
We're seeing that as more of an impact to the workforce and office demand going forward, right? So we see a lot more efficiencies in the workplace. So I think that's going to continue to transition. And with respect to, and I'm glad, this, it's going to, I think it's going to impact more of our kids going forward, but there's a lot of money being spent in that area. And that's, when you look at on the office sector, that's one of the positives with some of that expansion on AI, and how that makes buildings or real estate a lot more efficient from operating standpoint and from a maintenance standpoint. I think it's overall positive, but I think it's going to have a huge impact, not just on the real estate sector, but as society going forward, as we continue to pivot to try to leverage the positives and efficiency it brings, as well as whether or not we can envision sort of that 4-day work week that everyone has been talking about, and whether or not that becomes realistic based on AI. But I think it's definitely going to impact, we're already seeing the transition in the office sector with the work from home, but I think AI is also going to sort of result in more evolution of office and how we use real estate in general going forward.
I agree. We've seen different efficacy for different industries, particularly life sciences. You got to have real pause these days because the efficacy is through the roof. So if you're going to deploy $1,000 per square foot build cost, you may want to know how much staff you have. Are you guys seeing some of that caution when it comes to capital deployment?
Well, always, especially we have a cost group here, and the justification of some of these new projects and based on the rents, that's why we're seeing some pauses on even with some residential projects that were sold out about 2 years ago. There's a bit of a pause there in the way of construction. Construction costs have come off a little bit, but the capital expenditures to start these projects now. And the other thing that we didn't really mention is that life sciences has been sort of the buzzword of the last couple of years, and partly is some of the suburban office that got tagged as and the zoning as well for life sciences and some of the industrial flex space. But now we're starting to see a bit of a softening in that area. So I think we could still see an impact, but I think we overcompensated for that area. I think there's going to be a little bit more slowed, measured growth in that area. But in the way of construction costs, and never mind labor costs, that the challenge with our labor right now is that because we had the slowdown or pause on the residential side, whether or not we're going to lose that skilled labor. And if you believe based on the interest rates and that based on the population growth and the immigration that we're still seeing. Again, granted, is a little bit less so compared to a couple of years ago. We're going to need those workers that have perhaps moved to Alberta for that growth in that construction activity. But whether or not we're going to see the same issues with rapidly increasing costs because of labor and construction, just because we've lost the many of those workers over the last 6 or 9 months, is going to remain to be seen. So the concern going forward is that how quickly will the housing market come back based on interest rates and based on the overall demand, and whether or not we're going to see that bounce back based on softening sale prices over the last 18 months. Steve, sorry, now I'm turning negative.
Yeah, I mean, it's generally a roller coaster in any of these conversations. We just try to keep it away from becoming a therapy session.
Yeah.
I think that's a good start there. What are some other key indicators that you look at when you're looking to see what can impact real change in the market? You talked about interest rates. What would be something else that perhaps you're watching?
We look at mortgage and arrears, and the mortgage arrears for Canada, I thought it'd be a lot higher. We're still at, I think, 0.18 or 0.19% of mortgage arrears this year. We're definitely a lot lower in the US, and US is around 1.5%. And I thought ours would be a little bit higher and the US be a little bit lower because you can look at a 30-year term on their mortgages compared to us at 5 years. So, and that's a positive. So if that number gets a little bit higher based on the interest rates remain at a certain level, that's one thing that we watch. We also look at the employment numbers. What is that growth in employment numbers that will impact? Usually when we see employment in a certain sector, it usually impacts the real estate side anywhere from 6 to 12 months. So the softening that we're seeing in the tech sector, that's been the growth in the office markets, especially with Ottawa and Toronto over the last 2 years. So whether or not that's slow, so we look at the employment numbers, we look at consumer distress levels, and then we look at what's happening with, of course, the influence with the U.S. and where we're at with their Fed rates, and what are the other concerns, like what we're seeing geopolitical issues that pop up. That's more noise in the market that we see that sort of impacts perhaps the stock market rather than real estate market. But what are the things that may stay on? Like we didn't really anticipate, 2+ years with the Ukraine war, right? And then we sort of got through that through shortage of supplies, and partly that was also COVID, that we didn't have people working in factories. That's where we're going to see that impact of AI with respect to the fully automation of some of these manufacturing, so we don't it's going to be, we're going to have less so shortage of product and materials, I think, going forward. But the overall aspect is that we look at a number of indicators and we try to piece it together with the economy. And then real estate, there's a lag factor in it, right? When we look at transactions, there's a 3 to 6 month lag factor of when it actually takes place, and then the impact on the market. So we try to look at economic interest rates, employment, and consumer health as sort of those indicators moving forward as we run our forecasts.
That's fascinating. I think one of the other takeaways I had with your slides and how I feel specifically in the office sector, downtown Vancouver, it's going to take us 7 to 8 years to deliver a Class A product, right?
Yeah.
And that timeline, it's not dissimilar from a lot of metros in Canada. So with the shortage of labor and I'm seeing now in your charts a slowdown in deliveries on industrial with leases softening and pre-sales are soft in both condo and industrial, we're going to have less deliveries. So more demand with more population for the existing infrastructure. Is that echoing some of what you're seeing?
There's a debate on this that whether or not, and this came up in Vancouver a number of times, that Vancouver's office market is a little bit more balanced than Toronto. Our suburban office vacancy rates has always been high. Vancouver has been a little bit more of a balance. Same thing to a certain extent, Calgary, but they've had that big office vacancy rate in the downtown and more of a sort of a lower vacancy rate in the suburbs. But the question is, if the demand right now is in your newer Class A building and some of the office buildings in the markets are functioning obsolete, in a span of 3 to 5 years, will we be undersupplied in office again based on what's needed? And what are we going to see in the way of transition of some of the older office buildings? And I know it's a lot more complicated because there's employment lands that doesn't allow for transition to office to residential, and it impacts the tax base. But in 3 to 5 years, because it takes that long to build a new office building, will there actually be a shortage of office buildings or function or space that tenants need? So in 3 years, we actually might have a shortage of office space, and that's hard to believe right now based on where we're at. But again, it's a cycle of 3 to 5 years that may change how we see the market or see where that demand comes from.
I think you know where I fall on the side of that debate. Here's a great question. We got a couple here in the chat room. I'll start from the bottom. Tim, any thoughts on investment activity picking up, or is it cost of capital, expected return rates, and price discovery? And I think, yeah, we are in price discovery for some assets. Love to know what you're seeing, Ray, because I also just want to temper that. I feel personally that the capital gains, pull forward of sales is almost like a forced sell situation. So I don't know how reliable of an area that we're looking at in. I really do think that that's part of the discovery here. So what are your thoughts?
Everything that you just mentioned that is happening in the marketplace, that bid-ask spread between owners and investors still exist. The challenge with it is, if you look out on the private side, the private investors have been quite active in the marketplace, and especially with investors that have their own source of capital, right? Because the challenge on the office side is getting a loan unless you have a good relationship with a financial institution. And if you look at the impact of land is sort of flat, and we saw a decrease in activity just because it was difficult to get financing in that area. But from private side, private always dominate the marketplace. The institutional players have basically backed off, and reposition some of their assets. So that's why you saw the RBC Plaza in Toronto sell, and that's why you've seen some other projects such as the Amazon building, the Post building in Vancouver sell. Again, they sold at definitely a higher cap rate compared to that building was put on the market pre-pandemic. And again, that's for certain buyers in the marketplace that see that sort of opportunity. Look at Group Mock. They've been picking up Class A suburban half decent assets at really opportunistic pricing. One, they'll take the revenue on the existing space, but as well as looking at transition down the road into alternative uses. Plus, they also have their own source of investors that are backing up their type of acquisition. So for overall activity, I think it's going to be flat. But in the way of interest, I think there are some investors are going to try to jump the gun before interest rates drop and before perhaps price levels start to flatten. There might be some opportunity right now with some of the investors based on some of the portfolio managers that want to balance the portfolio or reposition it. So I think there's opportunities and risk in this marketplace. That's why it makes this market so interesting right now, depending on what sectors. And definitely, I think it's the sectors and lesser extent locations. If you have a really good asset and a half decent return, it depends on pricing at the end, and as well as availability of monies. So Steve, what I'm probably saying is nothing. That there's opportunities depending on how you look at it and where you are in the marketplace, and as well as your motivation for the purchase, motivation for the seller and the buyer.
Yeah, I think we're seeing a return to fundamentals. Something about location, people tend to say, but definitely needs to pencil in a much more conservative sense these days, and this spread needs to be there. I think another curveball I wanted to throw at you, we've just had a bunch of earnings calls with food retailers in America, and sales are down across the board. And not a single earnings call will mention GLP drugs, Ozempic and Wegovy. But yeah, I wonder, do you guys have leading indicator things like, do you have something that goes off when you see a correlation here as a risk adjustment for potential growth on that? Given the retail charts you threw up on Edmonton and Calgary, it was all food-oriented, retail-anchored assets on a lot of Western cities I saw there. So I'm just interested to see, do you guys have any internal conversations about that moving forward?
Well, the concern is with the inflation level and how food prices have increased, that those centers, there's still not so much that it changes investors or how we feel about food anchor retail, right? And I think that what we're going through is some of the adjustments based on where people are trying to focus their dollars. And then you had that Loblaws boycott. Whether or not that has impact on the real estate values, I think less so, because I think on those things that, especially what we saw during the pandemic, that those are, you're going to see a little bit of ups and downs, but overall those assets and those tenants remain. So I don't see that as a major impact unless we go into further inflationary or further GDP sort of stagnation in the marketplace. But again, that goes back into us looking at the consumer, either delinquencies or what their spending is and what they're spending on. But at this point, we don't see that retail sector food anchor as a major risk compared to some of the other sectors, especially the older office buildings that are in the marketplace. And going back to location, what we're also finding is location on office, close to major arterials, close to subways make good sense. But we're also seeing is that some of our preference is that even though it's a great location, as you know, you've heard this mentioned a number of times, center ice locations for office and industrial, that based on preference in some of the buildings, there is that preference that, yeah, location's great, but I'd rather be 3 or 4 blocks away in a brand new office building versus Class A buildings that's right on the subway line, right? So we're seeing that as a bit of a turn as well. The same thing with industrial. Amazon used to build these buildings out of nowhere, and the challenge was finding people to work some of these buildings, because of the almost, I would say 90% automation, some of these warehouse logistics now, there's a little bit less people dependent, still dependent to a certain extent, but compared to 5 or 7 years ago, the market's changed to a certain extent that you could put a building in nowhere, as long as you can service it on a minimalist level, you're okay to build that building. And if you have that similar use, the building that still kind of works. So you're probably saving on land and some of the costs for that location not to be right beside a highway.
Interesting on the cost front. We can jump into a bit of the hard costs that we mentioned in the chat here. We're seeing some moderation on hard costs out here. Wood is dropped, concrete's a bit flat, but really it's the labor piece. It's the labor piece and the distance from access to labor that has housing close to rapid transit as really a determinant of some viability of a lot of projects. Is that a common thread across the country?
Well, definitely, because I think government, the province, is trying to look at more trades or investment in trade schools. Definitely the experienced people, and whether or not there's a little bit more immigration that's targeting at that sector. That what we're seeing now with the slowness in the marketplace and other opportunities in the marketplace, that some of those, we may lose those skill set going into other sectors. It's a big concern. And if we're looking at sort of a resurgence in, we're already seeing that the impact on infrastructure and the investment in that area of shortage of workers. So I think the labor issue is going to be an issue going forward that we really have to get our heads around, because that sector is really suffering from good experienced workers.
Yeah, it seems that the barriers to entry, moving from that medium delivery size of product to larger scales, getting more and more concentrated. And so the big dogs are going to eat as the market shifts, and it's going to be much harder to get from being a small to a medium dog and moving up that chain, given the inherent advantages built into the system. So we're at 10:52. If anyone wants to drop another question in the chat, we're happy to address. I think we did have one question. What's your take on the warehouse market in the GTA area? Any comments on that?
I grew up on industrial. I love industrial, and it doesn't go high in way of rents, and when it falls, it doesn't fall as much. I think because of the demographics and continued immigration flow into, and that's sort of pushed the GDP in a positive with that population growth. I think warehouse industrial in large metropolitan areas always works. Even the older stuff with the less clear, we're seeing transition to other type of uses, such as like I don't know, beach volleyball, other type of retail uses that are closer to some of the residential areas. So from that side, you've seen a good use on the industrial side with the order stock, as well as continued strong demand. But the concern right now is whether or not the pricing has moved to a point whereby we're seeing a pullback in some of that demand for some of that product. So again, we are seeing increase in availability rates, but it's not that it's a concern that we're watching. We were always looking for cracks. If anything, what we've also seen is on the user side that they've come back in the marketplace and they've actually bought rather than leased, because there were less buyers on the industrial side, on the investor side, that are facilitating a little bit of opportunities for some of the users to buy versus lease, not be subjected to all these crazy rent increases that we've seen in the last few years. So I'm positive about GTA. I'm positive about warehouse logistics, not just in Ontario, not just Toronto, but across Canada.
Yeah, we've seen a softening in lease asks here, but it's also a separate world than your industrial asset with low site coverage, which is a fundamental use case for a vast amount of industries. That's kept up and kept going in terms of valuation. So there's sort of a separate story happening out here with that. So well, I think it's 10:55, or well, here in Vancouver it is. So for everyone else, I think we can definitely say that we really appreciated your time today, Ray. It's always a pleasure to hear
This
your
was a lot of
thoughts. We're
fun.
really
Thanks, Steve.
Oh, good. I'm glad that we can keep it lively. So thanks again for your time, and thank you everyone for tuning in. We will be sharing this recording with everyone. We really appreciate your attention. And Michelle, do you want to sign us off?
Yeah, thank you. Thank you, Raymond. Thank you, Steve. And thank you, the Institute, for offering this Region 12 insight for our Canadian, and especially with Raymond. Thank you. And if you're not already a member of the CCIM Institute or either of our chapter, please do so. Take a moment to sign up. And the newsletter will be at ccim.com. And Steve, do you want to pop up your website onto the chat so that your region can actually sign up for your membership? And we would like to take this opportunity and thank you again, as well as to thank you, Raymond and Steve, and all the participants.
Thank you.
That's great. I'll drop it in the chat and it'll be in the follow-up email as well. Thanks, everybody. Have a great day.
Take care.
Bye-bye.
Bye.